Keeping the faith. Should investors trust the stock market in the wake of technical problems that are too large to ignore? In today's cover story, you can't always get what you want, but tips on how to try when negotiating your next salary. Plus, how mood swings are hurting teenage retailers, and bond market blues, how to turn losses into gains. First Business starts now.
You're watching First Business. Financial news, analysis, and today's investment ideas.
Good morning, everybody. It's Monday, August 26th. I'm Angela Miles. In today's first look, the trading day starts with the Dow back above 15,000. The blue chips rallied 47 points Friday, although the Dow logged its third week of losses. The Nasdaq added 19 Friday and the S&P 7 points. Gold gained $25 and oil up $1.24. A stock exchange merger may be in the works. Bloomberg News reports Bats Global Market and Direct Edge Holdings are in talks. Together, it would create the second largest exchange behind the New York Stock Exchange. Facebook tops $40. That can-do stock closed Friday at $40.55. Good news for IPO investors who are holding on to that stock. And a Dutch company reports 165,000 people are interested in a trip to Mars. There's still a week to sign up. We begin this week with Charles Moon of Trading Advantage. Happy Monday morning to you, Charles.
Good morning. How are you doing?
I'm doing wonderfully well. There's a lot of chatter in this market about the possibility of the Fed tapering come September. Do you buy into that, and what will it mean for the market this week?
Honestly, I think it's very overblown. It's been a lot of media hype, a lot of analysts kind of overextending themselves, kind of really gauging it towards a 7.3 number in the unemployment rate. Frankly, from the FOMC minutes, it was already shown that majority of the Fed members are in line with Ben Bernanke's timeline. They're looking at mid-2014.
So later on, what about the Dow crossing 15,000? What sectors would you watch, or maybe even Dow components that could move this week?
Frankly, a lot of it could be stocks that have somewhat bottomed out. We could see IBM and McDonald's really press to the upside. Now there's a technical level, it's the 200-day moving average that's suppressing McDonald's, but if it happens to clear, it can make a really nice rebound here, and it's the same thing with IBM.
What about the holiday weekend coming up? What will this mean for the trade? I know a lot of people are probably going to just take this week off.
That is the actual thought process, but we're seeing a little bit more volume coming in. They might be trying to get a little kickstart here. Usually it's after the Labor Day weekend when volatility and volume really picks up. We're starting to see a little bit of jump, so they might jump ahead. I would actually expect the beginning of the week to be a lot more active, and then the trading to die off at the end of the week.
Charles, thanks for your thoughts today. Have a good one.
You too. Thank you very much.
The Nasdaq is under pressure. The stock exchange operated without incident Friday, but now it's under the watchful eye of investors and investigators after shutting down 3 hours Thursday due to a technical glitch. Senator Mark Warner, who serves on the Senate Banking Committee, is calling for a thorough investigation by the SEC. Friday, even the CEO of Nasdaq conceded the need for a backup system, although he also tells CNBC the exchange operates normally 99% of the time. Julie Neiman of Smith Moore & Company says the problem's getting too large to ignore.
The SEC has been somewhat lax in pressing Wall Street to fix the problems. But when you're costing the trading public millions of dollars in this, and this is the third major incident that's occurred, we can't ignore it anymore because it does indicate that the problems are only going to get bigger before they get resolved.
The trading debacle is also gaining the attention of investors troubled by the breakdown in electronic trading.
It has a major effect on the ability for the economy to continue, and that probably what will happen is people are not going to trade as much as they're going to because they'll fear that their trades are not going to be transacted correctly.
My past 10 years of trading, it does affect me directly into the confidence that I have in the market's sustainability.
The SEC addressed the market concerns Friday. SEC Chairman Mary Jo White vowed to push for automated trading regulations, originally proposed back in March.
Traders and investors are considering their next move in Microsoft. Shares of the company soared more than $2 Friday on word CEO Steve Ballmer plans to leave within a year. It comes at a pivotal time for the company, which has gone from industry innovator to trailing market trends. Tech analyst Rob Enderle says the news took industry watchers by surprise.
I think most thought Steve was on board for at least another 3 years because he just done a major reorganization, and typically when that's done, the CEO will at least ride the reorganization through. And that's at least a 3-year process. So, yeah, I think this came as a surprise for pretty much everybody.
Enderle says insiders are eyeing Key Liu, Microsoft's current executive VP of applications, as a possible replacement for Ballmer, but adds there are likely other candidates in the mix, including outsiders from HP and software company VMware. We'll talk more about Microsoft stock coming up later in Chart Talk.
In light of a recent study that found nearly half of all job applicants surveyed would accept the first dollar amount of compensation offered, our cover story wanted to find out how to best walk that tightrope between grateful and greedy. In what some call a lingering after effect of the Great Recession, negotiating has gone out of the negotiation. Nearly half of all job seekers say they'll accept an employer's first offer without negotiation. That's according to online employment site CareerBuilder.
I don't think they should. I think you should always try and negotiate. Usually businesses try and lowball you when they're giving you a salary. Not lowball, but they try and aim lower. And it's unfortunate that 49% of people are not trying to negotiate more money for themselves.
They're going in with the understanding that I need to take this job because it might be the only one offered to me, when they really should go in completely educated on the position, on the company, on what other people in that role are making, and they can use that as a tactic, a negotiation tactic, but they also can use that as a confidence builder.
The tendency not to negotiate is strongest among women and younger job candidates. Eddie Ratner spends a lot of time coaching women out of that.
Women need to evaluate their skills and their strength both as entrepreneurs and as potential employees and say, this is who I am, this is what I know, this is what I deserve, and this is what I will ask for.
It may not always work. Taz Wilson is looking to hire 60 phone reps who will be offered $11 an hour. Not a lot of room for negotiating there, but for higher skill positions, Wilson says there is room. Post-recession, we found plenty of people willing to engage in the give and take.
It's better to negotiate than to just take the first offer.
How'd it make you feel to do that negotiation rather than just accept the first dollar amount?
It feels awesome because sometimes they go for it.
If you're still on the fence about pushing the envelope back across the table, you should know 45% of employers say they're willing to negotiate initial offers. And not everything is measured in dollars. A flexible schedule, more vacation time, even a cell phone may be factored into compensation.
What's been helpful for the U.S. housing market is hurting bank employees. Due to record low interest rates, millions of mortgage holders have already cut their monthly payments and are now on more solid financial ground. That has meant, however, considerably less stable conditions for the mortgage lenders working with troubled borrowers or homeowners who want to refinance. Both J.P. Morgan Chase and Wells Fargo have recently announced layoffs affecting a total of 5,300 mortgage lending jobs.
A sudden dip in new home sales could be a sign higher mortgage rates are causing home buyers to think twice about taking out a loan. Sales of new single-family homes plunged 13.4% in July. However, those sales are up 6.8% when compared with last year.
The dollar amount banks have already spent defending bad behavior is now reaching into the billions. The tab so far is reported to be $66 billion as the nation's big banks defend themselves in the wake of the 2008 meltdown. The money was spent on litigation in just the past 3.5 years. The analysis was done by SNL Financial. The bank's legal bills are expected to keep going up because the SEC and prosecutors are not finished investigating possible wrongdoing. The statute of limitations on such crimes is 5 years.
A Goldman Sachs trader has been arrested and charged with rape. Jason Lee, a managing director at the firm, was charged with sexually assaulting a 20-year-old woman at a home in the East Hamptons. Goldman Sachs says Lee is on leave from the firm in light of the charges. The banker's lawyer tells CNBC he adamantly denies this happened.
Chrysler Jeeps are again the target of a safety investigation. This time, it's the 2012 Jeep Grand Cherokee. 3 drivers have reported sun visors catching fire while the car was in motion. All 3 incidents happened within the past 4 months. The Cherokee is one of Chrysler's best-selling models. A recall would affect about 146,000 Jeeps.
Efforts by the Justice Department to fight health care fraud are paying off. 6 Florida hospitals are coughing up $26 million as part of a lawsuit. The hospitals, part of a network owned by Shands Healthcare, are accused of overbilling consumers. Patients claim the hospitals wrongly admitted them for overnight stays instead of treating them as outpatients. Since 2009, the Justice Department has vowed to crack down on fraud in the medical community.
Tesla sales may be ready to accelerate. The electric car company claims pre-orders in Hong Kong top orders from the UK, Japan, or Australia. The company plans to open a showroom in Beijing this year. Also, Tesla's S model was recently given a 5-star safety rating, the highest available from the government. But the company was given a wrist slap shortly after CEO Elon Musk erroneously tweeted the car had been given a 5.4 rating. The government made it clear such a rating is not possible.
Koch Industries says it's no longer interested in buying any Tribune newspapers. The multi-billion-dollar company is run by conservative Republican brothers Charles and David Koch. The pair is reportedly still interested in acquiring media outlets, but after a review of 8 different Tribune properties, the Koch brothers decided to take a pass on those.
The government's plan to stop the merger between American Airlines and U.S. Airways is getting pushback. Reuters reports political and business leaders in Florida, Texas, and North Carolina want the deal to go through. They say it's better for their local economies. Also, American and U.S. Air are said to be pushing for a fast trial. They are asking the judge to hear the antitrust case November 12th. The government is suing to halt the airline merger because it creates the world's largest airline and could hurt consumers.
Would you pay extra for an airline ticket that guaranteed you wouldn't have to sit next to a small child? An increasing number of airlines think you would. For fees ranging from $4 to $25, several Asian carriers, including Singapore Airlines and AirAsia X, are offering child-free zones. Analysts caution a backlash could hit any U.S. carrier that attempted to implement something similar.
On the economic calendar for this Monday, it's durable goods orders. And on the earnings calendar, watch for Joseph Bank and Coldwater Creek. Still to come, if moves by the Fed have you worried about your bond investments, a guest on our show will help ease your fears. Plus, some teen retailers are losing popularity. So which ones are part of the in crowd? And are we approaching the death of the department store? Bill Mahler steps in next after this In the Know message.
What's going on with Sears? Once again last week, more bad news. Losses were up, revenue down, the stock price has now tumbled. What's the problem here? And here's the question. Do the woes at Sears say anything about the larger model of department stores in America? Is there something wrong there? Let's talk with Joe Cahill, a columnist at Crane Chicago Business. Now, this is interesting, Joe. You call this, I'll quote you here, the longest running corporate train wreck you can remember.
Yeah, that's right. Well, Sears' decline traces all the way back to the late 80s and early 90s when Walmart started attacking their customer base. That was followed, of course, by Target and Costco. And then in this decade, you've had the rise of Amazon as the dominant online retailer. And all these trends have hurt Sears badly and set off this long, slow decline that we're seeing.
And the CEO and the man who owns all the stock, Ed Lampert, he's been dancing. He's been trying all kinds of new things, and they point out that their loyalty program, it's got good positive growth numbers.
Well, they're signing up a lot of people for their loyalty program, but the key to a loyalty program is to get the people who join the program to buy more from you than they were already buying. So you can make everybody who shops there a loyalty club member, but if it doesn't make them increase their purchases from what they were buying already, it's not going to lift
hurts
your
you because you're giving them discounts.
And you're right, you're giving, and that's what we saw in this quarter. Sears sales continued to decline despite the growth of the loyalty program, and the giveaways under the loyalty program squeezed profits.
All right, Joe, the larger question here, is there something inherently broken with the department store model? Has that era passed?
It certainly appears to have. You see similar problems with JCPenney. Montgomery Ward's, of course, disappeared years ago. The business model that Walmart and Target pioneered was more attractive to people and remains so to some degree. And then, of course, online shopping has become the preferred model for a lot of people.
So the long, slow decline likely to continue unless they can come up with some magic to figure it out.
Yeah.
All right, Joe Cahill from Cranes. Thanks so much.
Thank you.
Investors are left with a mixed bag when it comes to retail stocks. Best Buy was the top performing stock last week after the company reported better than expected earnings from cost cutting. GameStop was also a winner with a nearly $10 jump Thursday when it raised its forecast. La-Z-Boy stretched higher after reporting that first quarter profits doubled, but Staples was one of the biggest losers last week, slipping 16% on lower sales of office supplies as trends change in the business world.
Thank you, Chuck. Still to come, why investors and retailers that cater to teenagers are losing their cool. Also coming up, a savvy trader shares his secrets on how he makes money in the bond market. We'll be right back. Investing in bonds can be just as risky as investing in stocks. Here to help us sort out the action plan that you might need for your portfolio is Glenn Schultz of Performance Trust. Good morning, Glenn. And let's just start with the bond basics. What's the difference between a bond, a bill, and a note?
That's really the maturity of the instrument. So bills have a maturity that are less than 1 year, and they're priced at a discount. Notes have maturity greater than 1 year, less than or equal to 10 years. They carry a coupon. And bonds have maturities greater than 10 years, and they also carry coupons. So the big difference between bills, notes, and bonds is largely where they sit on the maturity spectrum.
I'm sensing some investors may be feeling nervous right now because interest rates are rising, so those bonds are not worth as much as they used to be. They're opening their portfolio statements, not looking good. What would you do here?
Well, what I would do here is begin to shorten the maturity of my bond portfolio and at the same time begin looking for higher yielding instruments. That higher yield or higher coupon off of that will actually work with the maturity to reduce the risk of the portfolio. So bond prices move in the opposite direction of interest rates. The longer the maturity, the greater the price risk of the bond. So as you come in on the maturity spectrum, you have less price risk, and as you have more coupon income from that, you also reduce the price risk of the bond. So what I'm doing, a lot of investors are doing, is they're beginning to look to the loan market for alternatives to, say, the Treasury bond market.
Here's another issue that's coming up. People are told, put your money into bonds because it's safe. And usually we see the stocks and bonds moving in different directions, but now they're moving in the same direction. What does it tell you as a trader? Should they be concerned?
No, they shouldn't be too concerned, but what we are seeing here is a dislocation between the normal behavior between the equity markets and the fixed income or bond markets. And this has really been brought on by the Federal Reserve's asset purchase program. So not only are they looking to lower interest rates by purchasing bonds, but they're also looking to raise the price of risk assets or equities through that program. So what's happened as people begin to factor in the tapering of the Federal Reserve's purchase program, stock prices and bond prices are falling together as investors anticipate an exit of the Federal Reserve's asset purchase program. And that's caused positive correlation. So normally in a portfolio you have stocks and you have bonds because stocks rise and bonds normally would fall. They're inversely correlated. And right now we're just seeing positive correlation. But at some point we'll return to a more normal market.
Good to hear. Thank you, Glenn Schultz of Performance Trust.
Thank you.
Just ahead, is it time to stock up on Microsoft as the CEO steps down? And the teen retail stocks that are no longer hip on Wall Street. Chart Talk is next. James O'Malley of KeenOnTheMarket.com is here to talk about Microsoft and more. Hello to you, James.
Hello to you.
Microsoft had a major move on Friday. Will that continue into today's trading session, do you think?
Right, I think that this move could continue here. There is one major consideration and one very key level that I need to keep my eye on in Microsoft. Now, on August 8th, a trader came in and bought 150,000 of the SEP 35 puts, meaning that this trader has 15 million shares of stock that they could sell to take profits above 35, meaning anywhere above 35, there could be some pressure on the stock, so I really need to keep my eye on it, see how it reacts at that level.
And what about some of these teen retailers, James? Last week, some terrible action in Abercrombie & Fitch, for instance.
Right, terrible action in these retailers. I think these are going to be the new stocks that everyone is going to love to hate. Abercrombie & Fitch, Aeropostale, and American Eagle all get crushed on earnings. The Abercrombie earnings call was dismal, just disheartening. Their CEO pointed to massive changes in consumer preferences and tastes, and I think it's going to be really, really hard for these brands to find any kind of growth whatsoever from here on out. Now, if I want to be long, retailers need to look and rotate into names that have done relatively well this year, like Michael Kors, Urban Outfitters, or Lululemon. Even Fossil is another name that's held up relatively well this year in the retail space.
Thanks for coming on the show, James. Have a good trading day.
Thank you.
That's all the time we have for today. Coming up on tomorrow's show, are consumers all shopped out? Reasons why Americans are starting to keep a tighter grip on their wallets. From all of us at First Business, thank you for watching. Have a great start to your week.